Hi everyone, my name is Anup Sharma. I am a practicing chartered accountant. Today I will be talking to you regarding standard on assurance engagement 3420, which is about report on the compilation of Proforma financial information included in a prospectus. Just to give you some background, scope of the standard typically is for providing a reasonable assurance on engagements whenever there is a Proforma financial information which is meant to be prospectus as prepared by the client, which is meant for included to be in prospectus, like I mentioned. Typically, you'll see this kind of requirement whenever there is an capital market activity. That in a particular situation where a company plan to divest or acquire a business or any entity, there you would see requirement of Proforma financial information. Let me give you an example. For example, after 31st March 19, entity A, they plan to acquire entity B in say with effect from 1st May 2019, and effectively the issuer, they plan to raise money for acquisition of this particular entity B, or they would like to reflect the financial performance of entity A and B together so that it makes sense for the prospective investor. In addition to 31st March 2019 financial information for entity A, if the entity A chooses to combine on a Proforma basis entity B, say with effect from 1st April 2018, so it will prepare a Proforma financial information combining both A and B so that it can reflect the joint, I would say, combined results, financial performance, cash flow of those entity. When any particular investor, they are looking for this set of financial information, it can make sense to them what kind of number they would look if both entities are combined together. You will see this kind of requirement typically will flow from SAE, or recently you will see this kind of information are also required by REIT regulation or InvIT regulation, which kind of trust you will find they would require Proforma financial information in terms of which is called as combined financial information. I'll talk more about this kind of financial information going forward. So what is an PFI? Like I mentioned, when you give an effect of a particular transaction or event from a retrospective date and you present a financial information on Proforma basis, event could be like either company, like I mentioned earlier, they may want to acquire a particular entity on a subsequent date, but that event is pushed back to a previous date and shown a financial information on a combined basis. And what could be a transaction? For example, a company is having borrowing, and after drawing equity money, they plan to repay this borrowing, and the company plans to reflect a Proforma financial information from a retrospective date. Had the borrowing been repaid from a retrospective date, what would be the financial information look like? So it means, let me give you an example. Again here, for example, there is a borrowing in the books of financial statement of entity A, which they plan to raise money, and after raising money, they plan to repay it from a particular date. Let's say they plan to raise money in the month of July 2019, and they would, after raising the money, they will repay a particular borrowing which is there in the books of accounts. Now, if investor would like to see, had this amount been paid from a previous date, say for example, 1st April 2008. It means, let me give you an example. Again here, for example, there is a borrowing in the books of financial statement of entity A, which they plan to raise money, and after raising money, they plan to repay it from a particular date. Let's say they plan to raise money in the month of July 2019, and they would, after raising the money, they will repay a particular borrowing which is there in the books of accounts. Now, if investor would like to see, had this amount been paid from a previous date, say for example 1st April 2018, what would the financial information look like? in that particular financial, what would happen? Instead of borrowing, you'll so reflect it as an equity, as if the equity money has already been received on 1st April 2018 date. On that day, you will make a Proforma adjustment, which is not an actual adjustment, which is a Proforma adjustment. You will take out borrowing. So as a result, you will also remove interest part, and any corresponding adjustment, whether it is interest, deferred tax, you will also give reflect to that financial information. So for 18-19 financial statement, you are redrawing a financial information on a pro forma basis, assuming if the transaction has already occurred from a particular date, in this example, which is 1st April 2018. Next, if you look at the standard also talks about applicable criteria. Typically, these applicable criteria you will find in the regulations, SAE regulations, ICDR regulations, or REIT or InvIT regulation. If these criteria are set, the Proforma financial information will be prepared as per those criteria. If it is not there or not provided, then the company or the entity has to make an assumption and make a criteria which will be disclosed in the financial statement, and that becomes the basis of preparation of financial Proforma financial information. Now, if you look at, so like I mentioned in the next slide, slide number 5, you will see that how do you make a Proforma adjustment? So there is an financial information which is already reviewed, audited, or examined, and now you have a situation where this is where you are required to provide a Proforma adjustment to that particular financial information to illustrate an impact of a significant event or transaction. And one more thing I need to highlight here: Proforma financial information are prepared based on consistency with applicable financial reporting framework. So underlying financial statement, if those have been prepared, like in my earlier example, if you go when entity A is acquiring entity B, so when you are combining on a Proforma basis, one thing needs to be kept in mind: both the financial statements, when you are combining on Proforma basis, needs to be on same set of framework. It cannot be different, otherwise it will defeat the purpose of overall purpose of preparation of Proforma financial information. Who prepares? What are the responsibility for the respective persons here? The client, they are responsible. They have the primary responsibility to prepare the Proforma financial information. We as a practitioner, we have reporting obligation to report on this sort of financial information. I'll explain more about what are our reporting obligation on this set of financial information. Now, like I said, purpose of preparing a Proforma financial information, which I have already spoken to you, and also to mention here, these are not real financial, these are not actual financial information. In my example, like entity A underlying audited financial statement would be a real or actual financial statement. Also, entity B's financial statement for the particular year 18-19 would be real financial information. However, when you are combining them on a pro forma basis to create a pro forma financial statement, just to give a sense how the combined pro forma financial statement would look like. But please keep in mind, these are not real because this transaction has not happened. You are only making an assumption that had it occurred with a prior date, how would the profit and loss statement, balance sheet, or cash flow statement look like, so that the investor gets a sense, the reader gets a sense going forward when the acquisition has happened, what would the financial look like. That is the whole objective of the pro forma financial information. How does a client prepare or compile a pro forma financial information? First, you need to the client needs to look at what are the sources of unadjusted pro forma unadjusted financial information, which mean in my example, earlier example, the underlying audited or reviewed financial statement for 18-19 of A, similarly financial information of B. Those are unadjusted financial information. Then you will take extract of those information from the relevant audited or reviewed financial information. You'll put so that those will be reflected in first column. Then you'll reflect pro forma adjustment in a second column. And third, then you'll, after giving pro forma adjustment, you'll reflect the total financial information after providing pro forma adjustments. To make it more sensible, it is required that what are the kind of proforma adjustments are being made, those needs to be disclosed. How those proforma adjustments have been treated, those needs to be appropriately reflected in the financial statements. We as a practitioner, we are required to provide a reasonable assurance as to confirm whether the proforma adjustments are given effect to those financial information, and we need to assess whether the criteria used in compiling PFI financial information provides reasonable basis for presenting significant effects directly attributable to event. To be able to do that, we are required to obtain sufficient appropriate evidence both for underlying information and for proforma adjustments. When we are issuing a report on proforma financial information, it is not required, or generally the objective is not to reissue an opinion on the underlying financial information or to update the report which have been issued on the underlying unadjusted financial information. Now, typically when you are performing an engagement for SRE 3420, similar to any other assurance engagement, you are required to perform engagement acceptance formalities, you are required to do planning, then you are required to do work out a maturity, then you are required to work out the procedures to assess whether you have obtained adequate appropriate evidence, then concluding whether the opinion should be a modified one or unmodified one. We'll talk on those part little later. Like I mentioned, before accepting the engagement, both the client and the practitioner, they are required to agree on the acceptance formalities, scope of work, what are the underlying financials, those would be considered unadjusted financial information will be considered for preparation of proforma financial information, what would be the proforma adjustments, and responsibility of each others while reporting on this kind of information. Planning and performing an engagement. First, the practitioner should assess no conflict with laws or regulation. And one more thing, the practitioner should keep in mind that there should not be any wrong or misleading proforma adjustments which are put through. Those should be factual. The proforma, I'll give you one example little later. The proforma adjustment should be more of a factual nature. Like I mentioned, I provided in my earlier talk two examples when entity A is planning to acquire entity B from a particular date after the balance sheet date. So and they are planning to acquire entity B after 31st March 19. So it's a real effect which you are providing, the factual effect provided to the proforma financial for the unadjusted financial information to be able to prepare a proforma financial information. Then one more thing someone should keep in mind, these proforma adjustments are directly attributable to event, transaction, anything relating to those transactions. Like one example I provided, if the objective is to draw money through equity and repay the borrowing, so any transaction relating to those borrowings should be dealt appropriately in proforma financial information, not others which are not related to that transaction. Similarly, when entity A acquires entity B, anything relating to those combination, if there are transactions like intercompany transaction between A and B, those should be eliminated. Those are appropriate set of proforma adjustments to be made while creating proforma adjustments. However, some of the adjustments which are not relevant this type of transaction, or for example, if you are creating when we are combining with a retrospective date, if you are assuming that there will be some additional transaction, for example, additional payments to some employees or some other thing, one need to keep in mind whether those are relevant and appropriate in this kind of transaction to be able to take a conclusion whether those are directly relevant for creating a proforma financial information. This should be factually supportable. These numbers cannot be, or the proforma adjustments which are being put through cannot be arbitrary numbers. It should be supportable with the underlying facts and figures, and those should be considered for preparation of financial information. Also, like I mentioned earlier, that the policies or financial reporting framework for both entity A and entity B, both the entities which are being considered for preparation of proforma financial information. If there are differences in policies, if one gap one gap financial information cannot be added or combined to a financial information of another gap financial information, it will not be appropriate and it will not make sense. So for example, if suppose entity A has prepared India's set of financial information for 1819 and B, when it is let's say prospective acquisition, entity A plans to acquire from 1st May 2019, and in past for let's say entity B has prepared its financial statement as per Indian GAAP. Now, if there is a pro forma financial information that is required to be prepared, first of all, the financial information of B, which was prepared under Indian GAAP, needs to be converted into Ind AS. Then only it should be combined with entity A for the purpose of preparation of pro forma financial information. Otherwise, what will happen? It will not give a right picture, and that should not be the case while considering preparation of pro forma financial information. As we consider in any other assurance engagement, examination engagement, or audit engagement, similarly here also the practitioner, they are required to work out a materiality threshold. The materiality threshold should be considered on combined basis, as if the way you will work out a materiality threshold for reporting on consolidated financial information. In this case, in my example, if entity B is considered to be combined in entity A with a retrospective date, then the combined financial information should be considered for materiality threshold. In a contrary example, suppose in entity A there are 5 segments, segment 1, segment 2, segment 3, segment 4 and segment 5, and suppose the entity A, they are planning to divest segment 5 from a particular date, say after 31st March 9. Let's take an example from 1st June 2019, they are planning to divest segment 5, and entity A plans to prepare its pro forma financial statement excluding segment 5 for the period 18-19. So in that case, when you are or we are required to report on that pro forma set of financial statement, it will be appropriate to consider the financial information after excluding segment 5 for the purpose of determination of materiality. While working on an engagement like this, it is important, like in any other engagement, to understand the underlying business of the client, the underlying business of entity A, entity B. In my examples, how client is planning to compile pro forma financial information, what are the nature of I would say entity being combined here, relevant industry, regulatory requirement, other external factors there. All those things should be kept in mind while working on a pro forma set of financial information. Now, when the client prepares a pro forma set of information, like I mentioned earlier, the starting point is unadjusted financial information, which we typically also refer as a historical financial information. In my earlier example, entity A's 18-19 audited financial statement would be considered as an unadjusted financial information. Those we need to confirm either those should be audited or reviewed before working on an pro forma set of engagement. If in a situation this information, underlying information, unadjusted financial information are not audited, not reviewed, the practitioners are required to perform additional procedure to be able to have enough understanding of those underlying business. Similarly, when entity B is getting combined, it is equally important to have an understanding of those financial information as well. Assuming in a scenario where entities A or entity B's underlying financial statements are not reviewed or not audited,